watered down to what we really care about as real estate lenders. You've got issues like what the status of what the property is likely to rent out on the high end and the low end. Obviously, as a lender, you're looking at the low end, and you're also looking at things like the actual numbers for the purchase price, what it's going to cost to construct, and again, all of these things get broken down into component parts. So the construction costs get broken down further in the detail construction costs, and the opportunity itself gets broken down further in things like your loan terms. This is again debt investing. So what's the property cost now? How much are we putting in? What's the loan? And what's going to happen at the end of the 12-month period here? So I'm happy to flip anybody my spreadsheet here. And really, it's a good exercise if you want to get in on either end of this, meaning if you want to be someone who finds the opportunity and borrows the money, testing it out with something like this will allow you to figure out if you're thinking about all of the issues involved with a project. This is obviously an industry that seems really easy to get into. The barrier to entry is low, but the what's required for success is actually quite high. And that is going to be things like being very fastidious, very detail oriented when you're putting together a project. So what a lot of my lenders do is have me flip to their potential project holders something like this, and then to the best of their ability, the borrowers will fill it out, and then it becomes my job and the job of the underwriter, the lender themselves, whoever they partner with, an accountant, etc., to review everything that is submitted to figure out if the numbers actually make sense. On the lending end, obviously, there's a certain level of skill that gets developed as a lender to be able to smell a good deal and to smell something where the margins just aren't quite right. And even if a deal might appear to have 100% chance of becoming cash flow positive, and the point I'm trying to make is, as lenders get more seasoned, they can understand when there's certain opportunities that on paper might look good, but something about it doesn't seem right, where it's not a great bet to bet on. And so we as the lawyers who prepare your documents, what we do is make the lending documents so strong that it essentially makes it as easy as possible for you to pull the property back and mitigate your damages as well as possible in the instance that your borrower defaults on the payments or otherwise screws up. But it's not perfect. There's no easy answer, and there's no free answer to when a borrower defaults. It's not like the lending documents are, you just push a button and then the deed just transfers over to the lender. That's not how it works. There's all sorts of steps because the Constitution protects the ownership of property. In order to divest someone of their ownership of property, there's a lot of steps that have to get involved, and suddenly you have to factor in to your loan itself the idea that if this person defaults, it's going to take $3,000 to $5,000 and 9 to 14 months for me to make this right. And so that's stuff that you have to factor in. It's stuff that I can tell you about, but until you deal with it yourself, or a member of your team deals with it, you're never going to necessarily know what it's like and what the exit strategy is on a loan that gets defaulted. So we have the opportunity spreadsheet. The borrower application is a crucial part of it. As I said, there's two component pieces, the who and the what. The who is really important because it could be that someone has a track record 10 miles long, and you can review projects they've done. You can talk to folks that they've worked with, and you can understand quickly that you've got a very bankable project. And that takes a lot of pressure off, because if it's someone who has a reputation in the industry of being a upstanding, upstanding builder, upstanding, project manager, then the odds are that their reputation matters to them. And in that scenario, you're going to feel a little bit better, because they're not as likely, or however you think about it, to just to get started and just basically be fumbling in the wind, because this is how they make their living, and they have a reputation of same. So we've got, I took away all the personal information from this application before I showed it to you guys, because I thought that'd be appropriate. But you've got the LLC itself, and then you've got the breakdown of the ownership entities. So they say 123 Main Street LLC is going to be the borrower on this project. Then me, I have to pull all the LLC docs, review them as your lawyer, and then I have to figure out how to get these folks, locked up into this loan, because with debt investing, as the person borrowing the money, you are going to be on the hook personally. There's just no way around that. Any sort of major commercial, off-market, hard money, blah, blah, blah loan, even your residential loans, you are getting attached to that personally. It's not a likely scenario that you're going to avoid signing a personal guarantee when you get involved. So even though 123 Main Street LLC is the borrowing entity on the project, Joe Consul is signing a personal guarantee that says that if I fuck up, pardon my language, then the lender can come after me personally. So it puts more skin in the game. And on top of that, if I did anything duplicitous along the way, it allows me to attach that person to a lawsuit, and that sort of ugly thing that no one wants, but is sort of the unspoken undercurrent for a lot of this stuff. Meaning, if you screw up, there will certainly be consequences. That said, who is it? Where do they live? Are they married? If they're married, is their spouse going to be involved too? And if they're not going to be involved, there's affidavits they have to sign and all that kind of stuff. And then we've got the construction costs. Here, again, it's blank, but you're going to break down the construction costs and that's another spreadsheet that I can send you if you're interested. A sample construction spreadsheet. So you're going to see it broken down into every component part, starting with the demo, ending with hanging the chandelier. So all that'll be in there, timelines. And again, it's a great exercise for you to try to fill one of these out for a project, because it's overkill. And by fully evaluating things, you'll be able to catch yourself in situations where you're over assuming that your success is guaranteed. You can say, wait a minute, is it really only going to take 10 days? Whatever. But again, good exercise. And then borrowers' holdings, another ugly part of the situation when you're getting personally involved in borrowing money is your other assets are at risk. So a lender says, I could lend to Joe, who this is his first deal, and it seems like a good deal. Or I could lend to Bob. Bob, this is his 20th deal. And not only that, he's got 10 properties that he already owns, and those act as leverage for me in the event things go wrong. I know Bob's not going to want me to try to push all of his properties into foreclosure to try to recoup the money that he owes me. Whereas Joe's got nothing. So I'm more likely to lend to Bob in that scenario. That kind of stinks, but that's the reality of the situation. So that's your loan opportunity. So depending on what end you're on, you're either filling this out or reviewing it, and that's it. So we're still talking about debt investing. I've got a actual sample loan agreement. This is a version of what you sign when you mortgaged your house. If you own a residential property, they brought you that big stack of papers in triplicate. Flip one over, sign, flip, 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 flip. Goes from you and the wife, and blah blah blah. And this is a private money version of that. And a lot of the language and a lot of the legalese is exactly the same, only modified to frankly be more stringent, because the home that you live in is your personal residence. The mortgage is subjected, regardless if you're in PA, New Jersey, Texas, is subjected to much higher levels of scrutiny, because the government wants to protect folks' abilities to own and live in their own properties. So, like in Philly, for example, the ease at which you can foreclose on a commercial loan is infinitely more lax than on a residential loan. Residential loans, folks get all these extra built-in protections, to the point where the court can force a residential lender to refinance, tack on payments to the end, do whatever they can as the court to not kick anyone out of their home, and to allow them to continue with the American dream, because it just becomes a ripple effect. I dealt in foreclosure stuff when I first got out of law school, which is 2008. If you have any sense of history in the world, the real estate world, you'll know that was a poppin' time for that. In New Jersey was one of the biggest states that foreclosures were happening. So, it became really difficult to get rid of people as kind of a counterbalance to how bad the foreclosure crisis was. So residential, tough. Commercial, much easier. But the documents are very similar. So we've got a series of documents that can be anywhere from 80 to 160 pages. And I'll just kind of just blow through them. You've got a loan agreement that is basically setting out the terms of the entire thing. This loan agreement is an agreement between the parties that basically says, here's what we're doing. We're going to follow it up with a promissory note that's going to bind everybody. There's going to be a mortgage. There's going to be a balloon payment, and it all gets kind of laid out in your initial private loan agreement. And then we're always followed up with something called a post-closing agreement. You guys have seen this. This says if there's any minor mistakes in these documents, the borrower agrees to fix them. And if they don't, the lender can fix them for them effectively. Promissory note, the most important part in this debt investing type of scenario. This is a document that is a legal document in the eyes of the court that connects a borrower to a lender with a duty. The borrower is taking on the duty of paying the lender back in exchange for what the lender provides. In this case, it was $165,000. Promissory note, it lays out the payment schedule, and it's actually going to be followed by the payment schedule too. Is it monthly principal and interest? Is it monthly interest only? Is it, any way that you can think about repaying these loans is what we'll lay out here. What's the interest rate? I think this one was 15%, which is pretty tough. And in the middle of the promissory note is a crucial piece that all of you borrowers out there don't want, and all of your attorneys will tell me to take out, and I'll tell you to kick rocks, but it's the confession of judgment. Confession of judgment is the part of the loan where the promissory note, where the borrower says, I'm an adult, I've read through all of this, I know that if I mess up, there's going to be consequences. Unlike a residential loan, which we just talked about, where you can't do this in a commercial loan in PA and New Jersey, you're totally allowed to have the confession of judgment. This allows the lawyer, the foreclosure lawyer, not me, whoever is doing the foreclosure in the event this thing falls through, to take this to the court, file it, and get a judgment immediately. It's not going to be a money judgment. It's not going to be a possession judgment, but it's going to say that we reviewed the document and it allows for us to enter judgment. Now let's set a hearing to determine what that judgment should be. So it skips that whole step of having to prove the case in a lot of ways, because the borrower at this point, once they've locked into a confession of judgment agreement, they are now agreeing that they owe something. They're not saying we owe, because it could be that there's a disagreement with how many payments were made. That's expected. The lender is never allowed to just confess judgment for $100,000. It's going to be that the court brings you in and says, all right, prove what payments you've made, borrower. And if they can't prove they've made more than you're saying that they made, then the court's going to agree with you and say, all right, $100,000 judgment. Very different than a residential loan. So there you go. Confession of judgment. Let's see. You're always waiving your right to a jury. That's just the way it is when you're a borrower. All right, so we keep on trucking. Payment schedule. So on every loan, you may think of it as like an amortization table. This is something that gets attached to the back of the promissory note. How much do you owe each month? This is an interest-only loan from March. So yeah, that's like a 2-year loan, and it has a balloon payment at the end, which I'm highlighting here, and that's $165,000. So this is basically, besides the points that the lender's taking for the initialization of the loan, this shows you how much the lender is profiting each month. So for an investment, and really that's what this boils down to. So for an investment of $165,000 for, upfront, which was mentioned a little bit earlier, you're going to get 1.5, 2 points cash. Basically, you give them the 165 and you get some of that right back immediately, but they still owe you the 165. I don't make the rules. I just help people paper the documents. But then here's the bottom line. Your loan's worth almost $1,000 a month. So if you've got that much money to lend, you might be able to make another $1,000 a month. So just think about it. I mean, and this is a fairly conservative loan. So if you've got 3 times that amount of money, you could be making a few grand a month. And suddenly you can see how lending out money becomes very profitable, because money makes money. And that's what this stuff's all about. Then you've got the mortgage. The mortgage is obviously what gets filed against the property. I don't need to explain that any further. I'm sure if you're in this webinar, which I can't tell if you are because I don't know how many people are here, but the mortgage protects the property. It tells the world that there's a lien. The only difference between what I'm doing here and what mortgage you have against your house is there's certain commercial clauses in there. Makes it very clear that the borrower is not the homeowner who lives there and raises his family there. If the borrower signs this, and it turns out they're lying, and you didn't know it as a lender, you can usually get away with that and still evict them as a commercial property. But I've seen scenarios where the lender knew that the borrower was going to move into the property. They still had them sign as a commercial loan, and yet when the borrower defaulted, the court said, no, lender, you knew that this was a residential property, so you have to go through the residential process, not the commercial process, to get this person out. So that sucks. That's your mortgage. Balloon mortgage payment rider for these interest-only loans that have a balloon payment at the end. You might have a situation where it's a 30-year amortization table, but it's only a 5-year balloon, and this balloon document again gets filed with the recorder of deeds, and it just tells the world that you're only doing interest-only payments, as it says here, bada bing, and at the end of it, there's going to be one balloon payment for the entire outstanding principal balance, which likely is the same amount that was initially lent. Assignments of rents and leases. If you're not familiar with this document, the assignments of rents and leases is a document that any situation where the loan involves a tenant, either there's one in there already, and or it's it's a fix and hold where you're going to be renting it out, you're always going to provide the lender with protection in the form of assignments of rents and leases. This is a document that is very useful if you are the lender and the borrower defaults and they've got tenants in their units. You can take this document to the tenants and you say, hey, tenants, you pay me now because the borrower has defaulted. And so that's what the assignments of rents and leases does. It assigns those profits, those rental payments to the lender. All right. And obviously, I'm just sort of skimming through this. There's all kinds of, we could spend an hour just on this document, but I'm really just trying to give an overview of the private lending process. All right. Again, my name and email is in the chat. Happy to field any private lending questions that you guys have. My direct line's in there too. Do not call me on the weekends. Don't do it. Just don't do it. Okay. But you can email me. I'm going to get back to you. All right. Affidavits of acknowledgement of confessions of judgment. This is a document that follows your promissory note and tells the world that you know that you signed a confession of judgment. Nothing too sexy there. See all the stuff in bold, stuff you better read. All right. Unlimited guarantee of payment and performance, your security document. This is saying that there is a LLC borrowing money and there is a personal guarantor or several personal guarantors that are connected to the document. And they have guaranteed on behalf of the company that if the company fails to pay the money they owe, that the borrowers themselves are going to step up and they are going to pay themselves, otherwise be held responsible. That's your unlimited guarantee. Always signed by individuals, not individuals on behalf of companies, not, something that otherwise fails to properly bind an individual person. And the coup de grace is the deed in lieu of foreclosure. Gotta love a deed in lieu of foreclosure. This is a prime tool in your lender tool belt to allow you to mitigate losses when a borrower defaults. It allows you to go down to the courthouse and get the property transferred into your name. It's essentially got the same effect as a quitclaim deed, meaning it's not a warranty deed. You're not getting good title when you take a property subject, as a result of a deed in lieu of foreclosure. So you're still in the crappy position of having to clear title after you actually get the property. And as some of you might know, that could involve filing a quiet title action against the borrower to have the courts quiet their interest in the property. So you've taken the property over and now it's in your name, and that allows you to start paying taxes. That allows, all the things that you have to do to mitigate your losses and start getting the property to a point of sale. This is something this is what you're going to use to do that, but it's not giving you the property back fully because it's not warrantable title. So that's something that you have to think about. The deed in lieu, it's great, but it's not a panacea. It still requires a quiet title action to be filed. All right, keep on trucking. There's the actual deed itself. So, you'll look on the Recorder of Deeds website. You'll see that this is filed, deed in lieu of foreclosure. It sends title back to the lender. So once that gets filed as the borrower, you've lost your chance. And now it's just like, how easy are you going to make it for the lender? All right. Environmental indemnity agreement. This is something you sign when you buy a personal residence, every commercial loan. This basically says that anything that I, as a borrower, does to the property, I indemnify the lender against that. So if I decide to just randomly and improperly install an oil tank and it leaks into the ground, even though the lender has a very strong interest in the property, the lender is exculpated, no liability to them in terms of anything that I do to the property during my term of ownership. All right. And again, very long, lots of legal jargon in there. And that kind of brings us to the end of, kind of your standard private lending agreement, which isn't inclusive of things like, and again, this is where you start adding pages to this document, but there's all sorts of waivers that the lender can require and oversight that the lender can have in situations where the borrower is doing a full construction on the property. So you can have a GC waiver, you can have an architect waiver, things where the lender feels protected in the sense that they have proof that that the professionals are being paid to rehabilitate the property, and the professionals themselves are signing these waivers, giving them to the lender, so the lender knows that everything is good. And in a lot of cases, you as the lender are releasing funds when you receive these waivers. Security agreement, that's just another document that binds your company to the debt. And that's kind of it for a kind of a simple private lending agreement, hard money loan. Those are the documents. So, I got about 10 minutes left. If there's any questions, type them in the chat. I'm happy to answer them. But I opened up talking about equity versus debt investing. We talked about taking on debt. The idea of equity is, I think I might have talked about that a bit more last time, but I just kind of wanted to focus on the private loan agreement this time. But the idea of equity is where you as a real estate person with an opportunity to offer, say, instead of wanting to borrow money and getting personally hooked to the loan and all that stuff, you wanted to create a scenario where folks invest in you. And that's where we get this equity bit. So the equity bit is where, say you've got a 10-unit apartment complex in Hudson County, New Jersey. It's at a C right now. You think you could do really well in putting in whatever, $400,000, getting it up to a B plus, A minus. What do? You want to take on some equity. So you form a special purpose vehicle and you start taking on investors. And these investors are giving you money, and in exchange, they're getting a piece of the profit. They're getting an internal rate of return. But what they're not getting is the ability to manage the project. So they're not partners in the sense that they're LLC partners in the company. They are folks that are giving you money like you would give money to Vanguard to invest in a hedge fund. They're giving it to you to invest in your project. There's a lot more oversight on these kinds of deals because the SEC says, the Securities Exchange Commission says, that we want to have oversight over this process. We don't want Joe to be able to just take on all this money, puff up his opportunity and experience, and then just disappear. So there's oversight every step of the way, even though you are creating a fund which allows you, or a syndication, which is exempt from SEC filings. There's still a lot you have to do in relation to the SEC to prove to them that you've done enough. And those things are, how did you find your investors? What, and I had a whole slide that I had prepared regarding a best practices guide for solicitation of investors. I don't have time to really get into it, but did I do what I was legally allowed to do to find these investors? Corollary to that, are these investors qualified to invest with me? Are they accredited investors? And if they're not accredited, did my lawyer get the proof that he needs to be convinced that 60-year-old Jim, who's been working at I don't know, as an accountant, making a good living, but not the living that you would need to be considered accredited investor, but he squirreled away $2 million over the course of his career. So can he afford to lose $100,000? I have to help you evaluate that, and we have to tell the SEC that we did what we had to do to ensure that this person was not gambling their family's last dollar, however you want to think about it, to try to make a killing in real estate. Because the SEC wants everyone who invests in these deals to be able to lose the money, so they can afford to lose it. Is basically what it boils down to. What can you do to advertise? Those rules were changed in 2014 with what was called the Jobs Act. There's private and public solicitation, and again, that's all fodder for a different discussion. But so you find an investor. He says, "Hey, I'm interested in a deal." Blah blah blah. You send them your prospectus. You send them your operating agreement. You send them your syndication documents, and they then invest. As an investor, just like when you invest in a Vanguard fund, there are certain things that are promised to them. It might be an 8% internal rate of return, and then at a major, I don't know what you'd call it in the non-real estate world, but like a stock split or something like that. But in the real estate world, a refinance, say a property sale, then drives a certain percentage profit to the investors in that scenario. So I'm just trying to compare and contrast like the two main ways that money gets infused into real estate projects from outside folks, and that's taking on loans, and that's giving equity out as the person with the opportunity. Not really seeing any questions or any signs of life at all out there, and I'm coming up on 45 minutes, so I'll probably log off in a second. Like I said, you guys can email me, and I'm more than happy to talk. Joe Console, my firm's called Console Madison. Here we go. And we've been in business for 12 years, and I am happy to help. Thanks everyone for your time, and yeah, call me.